Hi everyone, welcome to my channel. Today I'll be discussing the difference between standard mileage rate and actual expense method after the tax reform. If you drive a car, SUV, van, pickup, or panel truck for business, you have two options for deducting your car expenses. It's either standard mileage rate or actual expense method. Standard mileage rate is for people who don't want to bother with a lot of record keeping or calculation. This method may give you a larger deduction if you drive many business miles each year, especially if you drive an inexpensive car. You deduct a specified number of cents for every business mile you drive. The IRS sets the standard mileage rate each year. For 2019, the standard mileage rate went up to 58 cents per mile from 54.5 cents per mile. To figure out your deduction, simply multiply your business miles by the standard mileage rate for the year. The rate is the same whether you own or lease your car. The big advantage of the standard mileage rate is that you only need to keep track of how many business miles you drive, not the actual operating expenses for your car, such as gas, repairs, taxes, insurance, etc. All of these items are factored into the rate set by the IRS. Oh, and you can't deduct the cost of the car through regular or bonus depreciation or Section 179 expensing because the car's depreciation is also factored into the standard mileage rate. The only expenses you can deduct because these costs aren't included in the standard mileage rate are interest on a car loan. This is a business interest expense deduction, not part of the mileage deduction. Parking fees and tolls for business trips, but you cannot deduct parking ticket fines or the cost of parking your car at your place of work, and personal property tax that you paid when you bought the vehicle based on its value. Now, if you use your car for both business and personal trips, you can deduct only the business use percentage of interest and taxes. Not everyone can use the standard mileage rate. You won't be able to use it and will have to use the actual expense method instead if you can't meet the following requirements. First requirement, you must use the standard mileage rate in the first year you use a car for business, or you are prevented from using this method for that car forever. If you use the standard mileage rate the first year, you can switch to the actual expense method in a later year and then switch back and forth between the two methods after that. For this reason, if you're not sure which method you want to use, it's a good idea to use the standard mileage rate for the first year you use that car for business. This leaves all your options open for later years. Important note here, this rule does not apply to leased cars. So if you lease your car and you use the standard mileage rate for the first year, you must use it for the entire remainder of the lease period. However, there are restrictions on switching back to the standard mileage rate after you have used the actual expense method. And that is if you took accelerated depreciation, a Section 179 deduction, or bonus depreciation on the car. You can switch back to the standard mileage rate only if you use the straight line method of depreciation during the years you use the actual expense method. Second requirement, you can't use the standard mileage rate if you have 5 or more cars that you use for business at the exact same time, for example, in a fleet operation. The third requirement is if you have incorporated your business and work as its employee, you can't use the standard mileage rate if your corporation supplies you with a car, or you use your own car for business and your corporation reimburses you for your business mileage. This rule applies to any employee who owns more than 10% of the company stock. In these instances, the employee must keep receipts for all business-related car expenses. As the name implies, you deduct the actual costs you incur each year to operate your car: depreciation, gas and oil, repairs and maintenance, depreciation of your original vehicle and improvements, car repair tools, license fees, parking fees for business trips, registration fees, tires, insurance, tolls for business trips, car washing, lease payments, interest on car loans, towing charges, and auto club dues. So multiply the total cost of all items by your car's business use percentage, and you determine your business use percentage by keeping track of all the miles you drive for business during the year and the total mileage driven. And for parking fees and tolls that are business related, deduct them in full. And as you may know, government fines and penalties are never deductible, so you can't deduct the cost of driving violations or parking tickets, even if you were on business when you got the ticket. Under the actual expense method, you can deduct the cost of your vehicle using a process called depreciation. Unfortunately, special rules apply to depreciation deduction for cars. These rules give you a lower annual deduction for cars than you would be entitled to using the normal depreciation rules. Great news is that the Tax Cuts Jobs Act greatly increased the annual maximum depreciation deductions for vehicles starting in 2018. Because of this, if you purchase an expensive car and use it over 50% of the time for business, using the actual expense method may result in a much larger annual deduction for business mileage than the standard mileage rate. All passenger automobiles are listed property. What is listed property, you may ask? It is a property that is often used for personal purposes. So the IRS imposes more strict requirements on deductions for listed property to discourage fraudulent deduction claims. Because passenger automobiles are listed property, you must keep mileage records showing how much you use your car for business and personal purposes, and you must file IRS Form 4562, the depreciation and amortization, with your annual tax return. Now, how much can you depreciate? You multiply the basis amount, which is the cost of the car, by the percentage of business use of the car to determine the total amount you may depreciate. You include the entire cost, even if you finance part of the purchase with a car loan. The cost also includes sales taxes, destination charges, and other fees the seller charges. It does not, however, include auto license and registration fees. Important note, before 2018, if you traded in an old car for a new one, you could elect to do a tax-free exchange in which the tax basis of the old car was subtracted from the cost of the new car. With this type of exchange, there would be no tax due on the sale of the trade-in. However, the Tax Cuts Jobs Act eliminated this type of treatment for cars and other personal property. So today, if you trade in an old car for a new one, you must treat the trade-in transaction as a taxable sale. You subtract the old car's tax basis, which is the original cost minus depreciation deductions, from what the dealer pays you for it, and pay tax on any gain or deduct any loss. Lastly, if you convert a car that you previously owned for personal use to a business car, your basis in the car is the lower of what you pay for it at the time you purchased it for personal use, or its fair market value at the time you convert it to a business use. And you can determine the fair market value by checking Kelley Blue Book. As I have previously mentioned, the annual depreciation deduction for automobile is subject to a maximum dollar limit. The Tax Cuts Jobs Act greatly increased the annual limits for passenger vehicles placed into service during 2018 and later. The chart shows that if you place a passenger vehicle into service in 2018, you may take a maximum depreciation deduction of $10,000. The second year, you may deduct $16,000. That's a whopping $26,000 in depreciation deduction in the first 2 years. $34,000 if bonus depreciation is also claimed. These are by far the highest annual limits for passenger vehicle depreciation that have ever been allowed. Just to show you how much of an increase this is, under prior law, only $3,160 could be deducted in the first year and $5,100 the second year for passenger automobiles placed into service during 2017. This chart assumes 100% business use of the vehicle. If you use the vehicle for personal use as well as business use, the limits are reduced by the percentage of personal use. So for example, if you use the vehicle 40% of the time for personal use, your annual deductions are reduced by 40%. Also, the depreciation limits are not reduced if a car is in service for less than a full year. This means that the limit is not reduced when the automobile is either placed in service or disposed of during the year. Auto repairs and maintenance costs are fully deductible in the year they are incurred. You get no extra deduction for repairs when you use the standard mileage rate. If you fix your car yourself, you may deduct the cost of parts, but you get no deduction for your time or labor. Unlike repairs, improvements to your car must be depreciated over several years and not all deducted in the year when you pay for them. Unlike a repair, an improvement makes the vehicle much better than it was before, restores the vehicle to operating condition after it has fallen into despair, or adapts the vehicle to a new use. So for example, Karen spends $100 for engine flush on her business car. This expense simply keeps the vehicle in good running order. So it does not make the car substantially better, restore it, or adapt it to a new use. Thus, the expense is a repair. The next example, Karen spends $2,500 for a brand new engine for her car. This is an improvement because it makes the vehicle much better than it was before. Improvements to vehicles can often be fully deducted in a single year through bonus depreciation or Section 179 expensing, but only if a passenger vehicle is used more than 50% for business. Improvements that must be depreciated over several years are depreciated separately from the vehicle itself. Important note, depreciation of the original automobile and the later improvements are combined for purposes of the annual depreciation limits. The recovery period begins when the improvement is placed in service. If you are a sole proprietor or owner of a one-person LLC, you list your car expenses on Schedule C. Schedule C asks more questions about this deduction than almost any other deduction, probably because of the IRS's general suspicion about auto deductions. You must also file IRS Form 4562, Depreciation and Amortization. This form is used to report your Section 179 and depreciation deductions for the vehicle. If you lease a car that you use in your business, and if you choose the standard mileage method, you deduct a set amount per business mile. You don't get to deduct your lease payments. Now, you always have the option of using the actual expense method. to deduct the portion of each lease payment that reflects the business percentage use of the car. Important note, whichever method you choose, you must stick with it for the entire term of your lease plus any extensions. You cannot switch. Typically, leasing companies require you to make a down payment to lease a car. You can deduct the business use percentage of this cost, but you must spread out the deduction equally over the entire lease period. Now, when you lease a car for more than 30 days and use the actual expense method, you are required to reduce your deduction by a relatively small amount called the inclusion amount if the car exceeds a certain value. For vehicles placed into service in 2018, the inclusion amount will only apply to vehicles that cost over $50,000. The inclusion amount is calculated to make the lease deduction about the same as the depreciation deduction that would have been available if the automobile had been purchased. The IRS recalculates it each year. You can find the inclusion amount for the current year in the tables published in IRS Publication 463, Travel, Entertainment, Gift, and Car Expenses. Well, I hope this video helps choosing which method works for your business. And if you like this video, please subscribe and give it a thumbs up.